as I've looked at this crisis over the last few years for The Economist, and it's interesting that we're now 4 years since Lehman Brothers went bust, and I think many of us still feel that the crisis is still not fully played out. There seem to be 3 sets of issues that I hope this panel are going to shed light on. One is that we obviously, I think, probably didn't see at the start of the period around 2008, but are now seeing rather starkly. There is a sovereign question that is being raised. What is the ability of governments to stand behind financial systems, and what are the implications of the policies that they put in place to support the financial system? Does that actually ultimately push us into areas that we hope we never reach again, whether it be an inability of government to actually support the financial system, or, on the other hand, a resort to policies like inflation as a way out of liabilities, and the ability to print money being the way that governments get out of the situation. The second set of issues seems to me relate to a whole series of regulations that have been introduced around finance, most notably Dodd-Frank here in the States, but all around the world different regulations have been either implemented or discussed, and I hope the panel is going to shed plenty of light on whether we think those regulations are well designed, what the implications of them are, whether they're well designed or not, and what they might like to see done to make the system work as effectively as possible. And then the third set of questions, I think, particularly relates to our understanding of risk and how it should be managed in a modern economy, and the extent to which many of the academic models and theories around risk management can be blamed, need to be amended, and how they interact with the real world, what is being debated in academia. Particularly I'm interested in how behavioral analysis is actually feeding through into our theories and practice of risk management, and what does that tell us about the prospect for future economic activity, future financial investment and management, and whether we're likely to have smaller, fewer crises in future, or more and bigger ones. So we've got a big landscape to cover. What I want to do is probably start with the most topical issue facing the world economy at the moment, which is the future of the euro and the European financial system and the European economy. And I guess I felt that the appointment of Mario Draghi as head of the ECB was probably the clearest indication that the euro would survive and would do whatever was necessary to make it through this crisis, because I'd interviewed him back in 1997 when he was trying to get Italy into the euro, and he promised me he would do all the tough things necessary to get the Italian budget to balance, and that they would make it into the euro, and they did indeed make it into the euro, but they did it not least because he created a put option to get a whole load of debt into the following year and thereby meet the Maastricht criteria. So he struck me as a practical man who would say the right thing in public but also do whatever was necessary in private, and that seems to have been what's happened with the euro so far under his watch. And so I think most recently my colleagues at The Economist have finally agreed with me that probably the euro is now likely to survive, and that there was a significant move in the last couple of weeks with the latest round of euro version of QE that has sort of seemed to have said to the market the same sort of thing. But I wanted to get Edmond Alfandari's take on, where are we with the euro? Are we near the end of the crisis? Are we at the beginning of the end? Are we at the end of the beginning? Are we, is the euro going to make it? And is it going to make it in a way that is slow and painful for Europeans and the global economy, or is it actually going to, now having maybe turned this corner, start to follow through with fiscal stimulus as well that helps the whole economy surprise on the upside? Over to you for a few minutes.
Okay, let me first introduce myself. I am now in business. I am on the board of GDF Suez and on the board of Crédit Agricole Investment Bank and other boards. I have been involved in politics. I've been finance minister in France. And in 1999, when the euro was created, I decided with a few friends of mine from various European countries, the UK also, to create the Euro 50 group, which was kind of a group of personality which at that time were aware that the story of the euro would be a difficult story, and obviously 10 years after we realized that we were right. It's unfortunate, but it's like that. Now, about the euro, I think that we have to speak about the euro. The euro zone is presently living an Indian summer, as you said, Matthew. There are a bunch of good news in the Eurozone. First, and probably the most important, is the announcement by Mario Draghi that it was ready to use the printing press to purchase a limited amount of sovereign debt under conditionalities, the OMT program. The second good news is the ruling by the Constitutional Court of Germany that the new firewall, the EMS, was not illegal. The third good news is the softening by the European authorities of the fiscal requirements of Portugal first and probably for Greece. And that will give them, this country, more time to put their house in order. And the last good news, which is not the least, is the confirmation by the population, the Dutch population, of a government which is pro-Euro. And it is the end of a long list of democratic votes in favor of the euro, in Spain, in Ireland, in Portugal, in Greece, in France, and that's the proof that the euro has still a very important democratic backing, and that's probably something that has to be stressed. Now, we cannot deny that there are still dark clouds. The sovereign debt crisis is not over, that's obvious. There are still discrepancies in competitiveness among member states. Economic activity remains very sluggish, mainly in peripheral countries, and some of these countries are in recession. But there is also hope. We certainly made mistakes in the handling of the crisis, but we learned, and we understood that we needed the ECB to be the lender of last resort on sovereign debt market, as it is in the US, in this country, as it is in the UK. Many countries have been forced to put their house in order. Obviously, the euro crisis has been a catalyst for structural reforms on pensions, or wages, on red tape, and so on. This reform they never made before. And also, we understood that we needed more discipline at the European level. Progress has been made, but we are still very far away from a true federal system, which is the answer for once for all exit of the crisis. Let me conclude this very brief outlook by a short remark about this country, because I am worried myself. The Fed has announced that it will launch a third round of quantitative easing. And I understand the domestic objective, which is to stimulate the American economy, reducing unemployment, and so on. But by doing so, the dollar gets weaker, which means that the euro is becoming to be stronger. And we in the Eurozone have a much weaker economic activity than in the US and a much higher rate of unemployment. And what we need, and I think that the world at large needs as well, is that in Europe we resume growth as quickly as possible. And the Fed's decision doesn't help in this respect. And this is a proof that we should come back, in my opinion, to the old days, which I knew as a finance minister, where in the framework of the G7 there was consultation among the main global players. Thank you. Thank you for listening to this message.
Great. I mean, a couple of specific questions to follow up there. I mean, one would be to get your comments on one of the risk factors that many people have seen towards Europe, which is the relationship between new French President Hollande and Angela Merkel, and how that's going from your perspective. And secondly, the broad challenge I think that we still, at The Economist, are not sure how it's going to play out is Angela Merkel and her ability to sell to the German people the kind of transfers of wealth and stimulus that may be in the best interest of the European Union. How do you see her prospects and what her strategy ought to be for doing that?
On the relationships between François Hollande and Angela Merkel, I should say that they come obviously from different worlds, but they are forced to find common positions. And in fact, I think that the election of François Hollande, even though it raises many questions on the domestic side of his policy, it forced the Germans and to understand that we could not go on like that without going back to some kind of economic growth. And that has been very important. There has been a change of mood. And so I think that it goes in the right direction, even though the domestic side, I repeat that, the domestic side of the policy of the socialists in France is not really in conformity to what the other countries, and Germany more specifically, wants for Europe. Now, how Mrs. Merkel will sell to the German people the orientations, actually. I think that there is majority of German people who realize that the breakdown of the euro would be a disaster for the German economy, a real disaster. And it would not be only a financial, monetary disaster, economic disaster, but a political disaster, because it would be the breakdown of the European project, the European construction. So I think that Mrs. Merkel, even though it is difficult, you see it, the population has hesitation, but in the end, it is following the orientations of the Chancellor, actually. And you see it not only on the part of the right of the CDU, but also on the part of the socialists. And so I think that she's not as weak as on this part of her policy. She's not as weak as some people believe.
So, Sir Paul, you sit in the City of London, among other places. I mean, how do you view, and how does the city view what's going on across the Channel, and how it's going to play out from here?
Well, I think that firstly the issue of the euro. I think a lot of people have thought that eventually, when the rock hit the hard place, money would be printed. It's almost a religious matter, the euro, amongst many continental European politicians. It has to continue, absolutely bedrock of the European idea, the European mission. And the European Union and related institutions are pretty good at fudging things. We've seen that for many decades. And so they've come up with a way of printing money that's not too obvious. Germans can't get too upset about it, apart from the boss of the Bundesbank. And you just press a button on a computer and money is magically produced, and it's pretty painless. And so that is the process. And we've done it in the UK. We've done £325 billion worth, and we're about to do a bit more. America's, of course, done a hell of a lot more than that as well. So pushing buttons on computers is an easy way to get out of a problem, it appears. Of course, in the long term, it isn't, because the more money you've got, in the end, all the goods and services must be divided by the total amount of money to get the value. But it does help. It may get the percentages up a little bit in terms of growth. I think that we need to look at it so that's the sort of Euro situation, and I think it will stagger on. But I think we also have to look at the economic activity side of the equation. And I think that is not good across the developed world. Roughly there's 1 billion people in the developed world, in North America, Europe, Japan, Australasia, and a few other outposts like Singapore and Hong Kong and the UAE. There are 6 billion people in the rest of the world. The 1 billion have an average income about $30,000, and the 6 billion about $5,000. Now, we can't really expect that disparity to continue. With globalization, both physical container ships and information, the web, etc., it's easier and easier to compete around the globe. And those 6 billion people are keen to get up to our standards. They see our standards on their televisions, and they think it's a good thing. And many of them are very well organized with long-term perspectives, strong family units, and governments which have a fair amount of power to achieve things. We're in the strange position where in the West, in the developed world, we pay people more not to work than they pay people to work. Now that can't be a long-term strategy, it seems. We have to accept that. Japan has shown us for the last 20 years, and they were probably the most advanced in terms of these things, how difficult it is to get economic growth. And I think we should politically be looking at a position in the developed world where there will be only little economic growth, however much money we throw at it by pressing buttons.
And I mean, as you sit also in the Gulf, with the Barrage Capital, I mean, how do your sort of sovereign investor community, as they spreading their money around the world, I mean, how are they viewing the opportunities and risks at the moment?
Well, of course, they've got a lot of money through the oil price, and there is a huge amount of money in the Middle East and other oil-producing countries. They obviously have huge internal investment requirements. For instance, in Saudi Arabia, the tens of billions being spent on all sorts of things. But they are still looking through their sovereign wealth funds at spreading their risk. And those wealth funds, of course, are very substantial. You can add to that, of course, say the Chinese government position with its 2 to 3 trillion available. And they wish to diversify. And I think when one looks at the world's not doing so badly. Growth is 3 to 4% of the world. And it was 4% last year, they reckon 3% this year, and perhaps 4% again next year. So there are opportunities. I do quite a lot of things in Africa. A number of African countries provide tremendous opportunities from a low base, but nevertheless a lot of services to be provided, and in Latin America and certain of the developing emerging countries of Southeast Asia. The most important thing to look at, I think, is the governance, the rule of law, and those issues. Given that you've got the rule of law in a country of that nature, there are very substantial opportunities in the developing world.
So, I mean, my sense of, for example, of the Chinese is that they're very worried about the short-term macro situation, particularly both Europe and America's fondness for printing money. I mean, you seem to be saying there's a much longer-term perspective being taken.
Yeah, I think the Chinese are well known for taking a long-term perspective, and the weakness of our systems at the moment is a great benefit to them in some ways. I was a director of Standard Bank of South Africa for the last 9 years, which is still the Chinese biggest overseas investment, $5.5 billion to buy 20% of Standard Bank. And the scale of it is just wonderful. I mean, the purchase was made by ICBC, the world's largest bank. They have 200 million customers, 400,000 employees, and they wish to expand. They wish to move from sort of 1.5% of their assets overseas to 5% and then 10%. And that means training 40,000 Chinese to run the people in the banks around the world, which they will then own. And they're doing that. They've started a program to do that. And the weakness of our financial system, I think it's quite likely in the next several years, we'll see purchases of European and possibly North American banks by the Chinese and other sovereign wealth funds. They've already bought certain percentages, as you well know, of British banks.
So Jim Leach, you again, big long-term investor, thinking about hundreds of thousands of pensioners and how they're going to be able to live on higher amounts than people are being paid in the developing world. I mean, what's your sense of the situation now as an investment environment, both long and short term?
Well, I think the operative word is that we are a long-term investor, and you know, notwithstanding the fact that we have people on trading desks, et cetera, we try to instill in them to look at the long term. You know, my personal conclusion, watching Europe day by day for probably all the way up until March, was that it really wasn't that productive for us to, as a long-term investor, to be trying to monitor this thing on a short-term basis, and basically concluded that yes, it'll probably survive, may lose one or two countries. Germany will clearly have to step up and carry the load for everybody else. Austerity will not get you out of the issue, but is necessary so that once you are farther down the road, you can stabilize. But let's just make an assumption that there's zero growth for a decade in Europe and carry on, because living this day-to-day thing is very, very, from our perspective as a long-term investor, very counterproductive. Now, I must say, maybe our lack of interest is driven by the fact that we had absolutely no exposure to sovereign debt in the euro, but we do and have been making a number of investments in the private sector in Europe, kind of on the periphery, usually in Northern Europe, just because there are opportunities coming up. I mean, one of the things, as you said earlier, printing money, you know, is the way the governments are trying to get out of this. And historically, that's what they've always done. The second thing they've done, too, is to stuff their paper into you know, public institutions, pension plans, et cetera. So that's one thing that we're keeping our eye on very carefully. And fortunately, the Canadian government isn't in a situation that has to do that.
But you do see, do you basically see the financial crisis as something of a wash from your perspective? Is it a blip on the map, what we've been through the last few years?
Well, it certainly isn't a blip. But I think it's something that's going to take us another, you know, 6 or 7 years to get to the new normal, whatever that is. But it clearly is going to be lower growth in the developed world, and the developing world will hold the best opportunities going forward. Now, there are some other things that are on the horizon that trying to factor into this. You know, the whole concept that the United States might become energy self-sufficient is kind of a wild card, and I'm not sure how that's going to play out. There's lots of environmental issues around it. However, you know, that could be a fundamental change and lead to what people have been talking about, a manufacturing renaissance.
What sort of time horizon could that happen?
It's going to be towards the end of a decade. But it's a wild card that could come at us that I'm not sure how will play out. You know, other wild cards out there, of course, are terrorism and political unrest. As you say, 6 billion people who are, you know, many of whom are well below the poverty line and are looking for jobs. Mismatch in our educational system between people who are graduating and educating and the jobs that are needed. I mean, there is this big mismatch. So we'll see. Lots of wild cards. Lots of uncertainty. As a long-term investor, it is important to have conviction, and it is difficult to have conviction in these days.
So, Roy, you're, I guess, more involved than anyone else on the panel in the day-to-day cut and thrust of the financial markets. And I mean, how do you react to what you've heard, and what's on your mind at the moment?
Well, what we're seeing is a complete breakdown in the normal signaling ability that market prices have to tell us how much to produce, what the impact of economic policies are going to be.
So you don't believe that the bond price really makes a lot of sense?
No, I do not. The value of speculators is that they basically tell you what you should buy and what you should sell. And right now, the prospect of continuing government intervention as far as the eye can see, everywhere, has meant that we don't know what the real interest rates will be, should be. We don't know when when inflation starts. And I think the problem that we have is that there's an illusion that we can somehow control these highly complicated, nonlinear dynamic systems that are the world's interconnected financial markets. You can't do that. The financial markets right now, you've probably all seen the old video of the Tacoma Narrows Bridge in Washington vibrating in a windstorm, and then finally it just collapses completely. That's what we're facing right now. And the solution is to set up a lot of fans and blow 75-mile-an-hour winds the other way, thinking that by adding energy to the system, by printing money, we're somehow going to calm the thing down. And the way I try to approach things is to look historically and to think metaphorically the way people generally approach, how the way people generally approach problems can give you insight into how to solve this problem. And we have a tremendous optimism bias right now that somehow this is all going to work. There are so many unknowns. There's no possible way that we can predict what's going to happen in the future. And the final image that I have for this, if you remember what happened last year in Colorado, there were a lot of old growth forests of pine and cedar and all that exploded in this tremendous conflagration because they had been managed by the government for years and years and years. And these sclerotic trees had just grown to a point where the fuel had built up, and there's nothing that could prevent a tremendous explosion and destruction of the whole thing. That's where we are right now. But unfortunately, to get a new forest, we're going to have to let things have a rather apocalyptic ending. And by trying to prevent that ending from occurring in each successive elected official's term, we're just making that final ending even worse. So I have a very, very negative view, and I think it is a tremendous illusion to think that we have any power as regulators, as government, as people intervening in this to stop this from happening. And we should just let our hands off, let the bankruptcy system, let the individual nations as the Euro, which I believe should be broken up, solve their own problems at a much more local level, and from that can come a renaissance and a new financial system that can provide the kind of growth that we need to support the world in the future.
I mean, some people would react to that. I mean, if Ben Bernanke was sitting here, he would say that was the recipe that got us the Great Depression in the 1930s. That's why we had to intervene and print money and save the banking system and so forth. I mean, what's your reaction to that?
Well, my view is that the intervention of government prolonged the recession, and we're doing exactly the opposite of what we need to do. We need to have bankruptcies. We need to let banks fail. Everything has to be, insolvent institutions need to fail rather than being
But wouldn't the entire system have gone down in September 2008?
That
would have taken years
to work
through.
It's going to take, at this point, this problem is never going to be fixed. We're going to have no growth forever unless this takes place. I believe that governments cannot solve this problem, and only by a lack of government and just the application of laws and kind of a local regrowth can there be a renaissance of economic growth.
So tell me how what's your scenario for the end game of this current situation? I mean, when you talk about apocalyptic outcomes, what do you have in mind, and what's the process by which we get from there?
Well, after what I just said, I couldn't very well deign to make a good prediction, could I? But I think if I had to do so, if you really forced me, I'd say we're going to have much less growth than we anticipate for much longer than we think, until enough money is printed that it begins to percolate, and rather than being a slow Bernanke-esque, well, we can just turn on the brakes and it'll stop on a dime. Instead, it's going to be a geometric and eventually exponential hyperinflation with catastrophic results.
So the investment strategy in that situation is what, to buy gold and put it under your bed or something? Is
that interesting question about gold. One of the things that I read was a story that in Austria after World War I, they obviously had a lot of hyperinflation, and there are some first-person letters that were reprinted in the book that I read. And at one point, the family that was writing the letters, the wife has to exchange her husband's gold watch for a sack of potatoes. So at that point, maybe gold wouldn't be such a good thing. But as a general thing to have, I would say things that have intrinsic value. Obviously, commodities have intrinsic value, and more specifically, I think things that have scarcity and value in any time, like art and musical instruments and real things that are not being produced, rather than gold, which is and has kind of a dubious value, would be a good thing to invest in.
Greg, I mean, the Barron's reader is very much a detailed market obsessive kind of trader type character. I mean, what are they feeling at the moment, and what do you
they're very attracted to income, to dividends, yield, wherever they may find it. MLPs, blue chips offering 3-4% yields, that really seems to resonate with them. A lot of those have had pretty big runs, though. The valuations are arguably stretched, but that's still really.
You think it's arguable still, do you? I mean, aren't they clearly stretched?
Yeah. It's a little bit case by case, but their value proposition is iffier than it was, like I say, a year ago. If I may pick up on the gold theme a little bit, I just wanted to mention that I think gold is really screaming to investors something. I mean, just for context, it's risen 11 consecutive years. It's gone from about $300 an ounce to close to $1,800. Some of that is due to most likely to negative real interest rates. But I think what you're seeing with the gold is that there's increasing and serious concern about the value of fiat currencies. And if you don't know what fiat currencies are, it means paper money that's essentially backed by nothing but the underlying faith of investors. Fed just announced QE3. You have ECB's adding liquidity. Japan, it's in a way arguably a race to the bottom. And our debt now is what? We're near 15 trillion. The Fed's balance sheet is roughly 20% of that. And what I'm concerned about is that it's increasingly, I think, while we've always known it intuitively, I think it's kind of really sinking in how we're talking about, Sir Paul was mentioning how by pressing buttons you can, presto, create money. You can't do that with gold and silver. There is no magical shortcut. And my concern is that this realization will kind of sink in, and there could be a real crisis of confidence. I mean, we've heard anecdotally about bank runs in Europe. I'm a little concerned about headline risk. Gold is near 1,800. Very good chance it'll hit 2,000. That will start to get some play in the media. That could spook people. And my concern is that this could somehow spark a real lack of, I don't know if it's a crisis, but there is some real risk there. I mean, aside from all the, about the banks and Glass-Steagall and what to do, my overriding concern, I think, is more related to this. And again, 300 to 1,800 in roughly a decade is a huge move. And in theory, I think it still has room to go up because inflation adjusted is below its highs. And your average person still sees gold as some wacky, exotic, strange investment and not so much as a store of value, which it historically has been. Last 10 years, it has been much more than that. It's been a way to reap massive capital.
Yeah, if anyone wants to know any more about that, I should take this opportunity to plug my recent ebook, In Gold We Trust, the future of money in an age of uncertainty, which is available very cheaply on Kindle.
$2.99, I think.
Oh, it's gone up to $4.99 now. Now the price of gold is rising, we think we ought to make more money on it. But anyway, I wanted to come to you, Leo. I mean, as someone who's both been, in the hottest part of the financial market when you were at Bear Stearns in its last days, and then now looking at it both as a practitioner and as an academic, I mean, how do you react to what you've heard so far, and what are the challenges you see in managing risk in this environment?
Well, it's great to be here. I will qualify my perspective by saying that we have spent the past number of years transitioning from risk management to risk intelligence. And it's a profound transformation because it's a transformation from looking back and trying to control things to a forward-looking, informed way of making better decisions, be it strategy decisions or investment decisions and so on. And when you look at the world that way, as an investor, as a manager of financial institutions, it becomes really interesting. So I'll give you the perspective that we share with most of our clients who are some of the largest financial institutions and investors in the world. Europe at 0% growth in the best case scenario for any foreseeable future. United States in a 1 to 2% growth for any foreseeable future. High unemployment, high underemployment, lower prospects for generations. That's the macroeconomic backdrop. What it results in is a low return, high volatility environment that is surrounded by all sorts of crises. And it's surrounded by crises like Europe, like hyperinflation, like Iran, and so on and so forth, which presents an incredible challenge for investors, boards, executives, because you need to have a two-pronged vision for that environment. One is, if this is my base case best scenario, what is my vision for how I'm delivering growth, earnings, et cetera, in that environment, where many of the business models are becoming inviable? And then how do I foster my ability to manage crises? And the two are very difficult to balance, because if I'm in the business of managing crises and at the same time remaining competitive in delivering earnings, it's very difficult to do. So the answer to that is really trying to conceptualize the trends, which is what we're doing today, equipping yourself with things like dashboards, radar screens, et cetera, and knowledge to react dynamically. Because if we see hyperinflation that is hidden from market signals, how are you going to monitor it? Who is going to monitor it, et cetera? If we see a breakdown in Europe, how are you going to do that? So that's the challenge. And I think it stems from the nature of the environment that we're in. If you start controlling risk and trying to suppress things, you're out of business. What do you do? So it's a highly complex, dynamic exercise, but I think we're in a very difficult environment. I'm more in Roy's camp than in other camps. I think it's unsustainable, but it may take a very long time, so we need to try to balance it.
So I want to follow up with a couple of questions that I'm also going to ask Paul and Richard to look at. To what extent do you think that the regulatory reforms that are coming into effect around the world, have actually addressed any of the fundamental causes of the financial crisis, and to what extent are they actually improving our ability to manage risk and to have as societies, the right amount of risk-taking?
Well, I forgot to mention 4 pieces of good news in addition.
We've got some good news.
The cost of doing business is increasing.
No, we haven't, okay.
Regulation is making businesses less profitable. Return targets have not adjusted to the new environment. So when you talk to pension plans, earnings of public companies, et cetera, they remain in the same kind of realm. In the propensity of companies to start leveraging up whenever they are faced with difficulties remains. It's an organizational feature. It's a feature of business models. So from that perspective, what's going on is putting more and more pressures on investors, on companies, to deliver unsustainable amount of earnings in a totally different environment. In my mind, eventually, it leads to people taking on more and more risk in ways that are hidden. And I can't see anything in the current regulatory reform that is going to mitigate it in any shape or form.
Richard, how do you view that?
I'd like to display what Roy would call some optimism bias here. History teaches us that people do start to lose their nerve at the end of a prolonged period of difficulty or of recession. And I would agree with everything that Edmund said and add 3 pieces of good news to the euro crisis. One is, one of the original sins of the euro that doesn't get enough attention is the drachma came in at too strong an exchange rate. And the U.S. has had 150 years of monetary union and time for relative prices to adjust themselves. We're starting to see inflation in the core relative to deflation in the periphery. And not just in Germany, public, but in the markets, I believe that, it's easy to say, let the euro break up, but people have started to contemplate, what does that mean? And we come back to the view that this is irrevocable. There's no way out. There are many equilibria. There's a good equilibria where if everybody believes that it's stable, interest rates will be low, governments are running primary surpluses more or less, and they can solve the sovereign problem. If everyone thinks it's going to be bad, it'll be bad. The realization that it is irreversible is starting to sink in. And, the austerity, as others have pointed out, there has to be austerity. And, what is, you see investment banking research that said it's going to reduce output by 1.32% in Germany. How do they know? Nobody knows what the multiplier is. It could be some Keynesian thing where government spends one less dollar, then people get the dollar, they spend 95% of that, and so on, so there's a multiplier of 5 or 10. It could be that government just, there's that much less spending, so that 2% less government spending means 2% growth. It could be that it crowds out private spending, so it has no effect. Or it could be the opposite. It could be that it actually increases growth because government crowds out private spending, and then there is increased business and consumer confidence. So nobody knows what the effect of austerity means, and it could be better than that. And in terms of QE2, okay, I was against QE3. I was against QE2. It turns out I was wrong. I mean, it needed to be done. Yes, we know that inflation is always and everywhere a monetary phenomenon. No one can argue about that. But the demand for money also goes up in a time of financial strain, low interest rates, the Fed paying interest on both required and free reserves. And in addition, there is less supply of, there's less maturity transformation by private companies, by structured investment vehicles, which good riddance to them because they were toxic things, and it's good that they're gone. We didn't need regulation to get rid of them. Anybody, could read newspaper headlines, knew they didn't want to touch things like that. So M1 is a substitute for some of these products that have vanished, and it's natural that the Fed should be able to increase the money supply without inflation. How can they take it off? Can they take it off without hyperinflation? Time will tell. But you don't need financial markets. You can look at the consumer price index, and the Fed will presumably react to that. I think the thrust of regulation to take the risk out of systemically important financial institutions and decentralize it is healthy and welcome. So that there's no model that is going to be strong enough or robust enough to be able to measure the risk of assets that large banks take, and to try to it's not well enough known that there's a single overarching formula that lies at the heart of Basel II that involves the Gaussian copula with a single asymptotic risk factor and correlations that are dictated by Basel II. It's absurd, and there were other pillars that were supposed to account for that, but they couldn't. So pushing the risk outside of banking system, letting banks serve their function as financial intermediaries is a healthy thing. And it's maybe halfway done or a third of the way done. I like the Volcker rule and its counterparts around the world.
It's the simplicity of the 300 pages that appeal to you about the Volcker rule, is it?
No, I don't like every twist and turn of the Volcker rule, but I like the fact that banks are taking less risk. They're not engaged. There's no reason why a bank should conduct proprietary trading. That's what hedge funds are for. That's what are all.
But you really think this is going to make a meaningful difference over the long run?
It already has. Banks are not taking the types of trading risks that they used to take.
Paul, how do you see it? I mean, do you see this reshaping of the risk landscape and who's taking it and who isn't that makes any sense to you?
Well, first of all, I'd like to say that I'm in the Roy camp. It's unusual, these sort of events, for there to be an apocalyptic person besides myself, but it's good to finally see people are catching on. No,
There's a panel this afternoon on science and medicine, which I think is going to be more uplifting, I suspect. Anyways.
But I don't have any gold, but I do have my money's in most of my money's in property, and Roy, I grow potatoes. If you ever need any. It's a nice watch you got there. No, I'm very negative. I don't really pay much attention to what regulators are doing, actually. What I do is I speak to the people and I kind of look in their eyes and I think, is this person someone who's intelligent? And they know what they're doing, and they're honest. And sometimes, well, it depends who you speak to. Regulators are honest but dumb. Politicians are clever but dishonest. And so I don't think there's anybody in charge who's actually doing anything decent. I'll give an example. I was on some panel, sort of a UK Treasury panel to do with high-frequency trading. Now, I'm very anti-high-frequency trading. I had various meetings with Treasury economists, and they, after a while, I stopped getting emails and being invited to meetings. This is very strange. Anyway, I had other things to do, so I didn't follow it up. And then I was speaking to a journalist, and he said, "Oh yes, all the high-frequency trading people on the panel have been quietly dropped because they want the outcome that, oh, high-frequency trading is fantastic," which I wouldn't have said. So there are lots of problems with the people at the top, I think. I also think there's a problem with just the concept of economics. I think of economics as sort of a disorder on the autistic spectrum, if you like. And there are lots of economists around me here. So, but what I mean by that is that people on the autistic spectrum, they sort of don't have an understanding, an intuitive understanding of how the world works, which is very much what we see of economists. And people on the autistic spectrum, as opposed to what they call NTs or neurotypicals, they create their own internal models of how the world works. And then, of course, all the time, they're finding things go wrong, and they have to they get very upset and angry and whatnot. And
was it Ronald Reagan who defined an economist as someone who sees something working and explains why it's theoretically impossible? Is that
right? No, that's not the same thing at all. I don't think economists see things. They don't look around them. They don't get the experience from the real world. Is the problem? They just in a little bubble. But they do have their own internal models, and when they're talking amongst themselves, they have this way that they think the world should work. And every now and then things go wrong, and they get very confused, and they have to change their models. So the analogy is pretty good, I think. No, I think.
So how on earth do we make sense of the world then? We just don't. We just grow potatoes and hope for the best, or?
No, I think if people had more experience of, for example, if you got rid of all economists, or forced every economist to start their own business and see how well they got on, that would be useful. Rather than just, and the same goes for MBAs. I don't really see the point of an MBA. You should. Roy, when did you start your first business, Roy?
13.
13, exactly. That's how it should be. We should all learn from people like Roy. So no, we're all doomed. I think the euro. The euro is the stupidest idea in the world. In the late 90s, I was writing a research paper on the mathematics of risk management during crises, and of course we use the example. This is just pre-euro. We use the example of what happens when the euro collapses. So, and as to timescale, I think another thing. I don't come across as too much of a Roy fan, but when he used the phrase about nonlinear dynamics, I think that's a key thing. So we can't predict anything, but we can say something about timescales. And I'd say something like the euro will be collapsing of the order of a generation, a human generation, because these things are ultimately human things. So expect things to happen over the span of a human generation. Also, back to economics, the very fact that only now people are talking about behavioral economics and behavioral finance, when actually it's human behavior that's at the root of all this. That should have been the starting point. It shouldn't be something that we finally get around to looking at. So, End of rant.
Paul and I would like to invite you to our seminar on Mayan astronomy following this session.
December the 22nd, is it? Anyway, but,
one of the ways that folks are now describing what we're dealing with, which I find to be extremely useful, is this language of complex adaptive dynamic systems. And if you in fact start describing the world that way, you sort of draw from all sorts of different walks of life the insights and descriptions of it. Like, for instance, Neil Ferguson, who started using this language some time ago, described it as teetering on the edge of chaos. And it takes just a little push to put it in a different state. And from his analysis, it was all based in fiscal crisis that typically pushes it in. And then system engineers started describing that the system has no circuit breakers, no buffers, and it has instantaneous sort of transmission of information. That's what we're dealing with, right? And that's what we're trying to control. And interestingly enough, one of the people who contributed to this debate from a totally unexpected angle was Nassim Taleb, the author of Black Swan, who published a paper in Foreign Affairs, out of all places. And he said that his hypothesis, self-serving, mind you, is that the moment you try to suppress something in that system in some artificial way, could be anything, dictatorships, monetary policy, you get larger black swans down the road, right? So I think a lot of the conversations today is this notion that whatever is going on is unsustainable, and it's an artificial suppressing of the natural functioning of that system, and it can only end badly. Whether it's some sort of terrorist attack that sparks it, or it's a hyperinflation, or it's a breakdown of a euro, nobody knows, can take infinite number of years. But the notion that it's a unsustainable path of an inherently unstable system that is artificially suppressed, I think that's where it's coming from.
So it's not, I mean, and would you argue that that is a state of mind as opposed to a piece of rational analysis?
No. I think it's an attempt, to Paul's point, and criticism is well taken, to create a description of reality, right? And I think the system does have these properties: instantaneous dissemination of shocks and information, opaque feedback loops that nobody can understand, etc. But I think all of us are getting a sense that whether it comes to too big to fail institutions that are getting bigger, or bailouts of auto companies, or monetary policy, or support of certain dictatorships but not the others, it's an unsustainable, unnatural suppression of the natural behavior of that system. And if that's the case, you probably will have larger, more severe dislocations down the road.
But what is the natural, I mean, do you therefore have a model of the natural behavior of that system?
Well, the natural behaviors, you don't artificially constrain the behaviors, right? Like, for instance, if you signal to the markets that interest rates are going to stay at 0 for 3 years, you've just distorted what the supply and demand and the signals from the short end of the yield curve are, right? If you embark on Operation Twist, right, you've just distorted any kind of notion of what forward rates should be, what the expectations are, et cetera, et cetera. If you start buying securities at the long end, any kind of signals about worries of inflation down the road are suppressed, right? So you're not going to see them until it's too late. So it's things like that.
Roy, you want to comment on this?
Well, I think what it all boils down to is a misguided attempt by governments to try to solve these problems, which do not have solutions. And we've talked about it.
Surely it is. I mean, there is no viable political strategy in which government doesn't get involved. When you have the kind of situation which, I guess you can go back hundreds of years, but certainly back to the 1860s in America, where the banking system collapsed. I mean, you cannot allow people's savings to be destroyed by the wealthy bankers and expect the society to remain viable in a democratic age, can you?
Well, it's not viable for the politicians that are currently elected, but it's unfortunate. I'm not suggesting that my solution is practical or going to happen, but it is the only solution, I believe. I wanted to just get...
So government stands by and lets...
Yes.
And you don't get rioting in the street and revolution and...
Well, I guess that's the role of government, to keep us safe, and maybe that should be the only role of government, rather than trying to manipulate financial markets. And by the way, I also want to point out, not just financial markets, commodity markets too. How do you know how much crude oil to drill when crude oil is going up $5 and $10 a day based on whether there's going to be QE today or not QE today? And when the government's trying to dictate what kind of energy we're going to use, and corn goes up, and you don't know how much corn to plant because that ethanol subsidy could be eliminated. Government control is at the root of every one of these issues, and unfortunately, it's not going to go away. So again, it makes me very pessimistic.
Paul.
Yes, I think it's remarkable how the politicians and regulators in many places are acting, because the seeds of this crisis, certainly in this country with the subprime mortgage, and there are at least 4 clear government actions that led to that. One was Clinton and Cisneros in 1994 saying the banks should lend more to the disadvantaged. Secondly, followed by Mr. Bush in 2000 saying yes, we'll do another 5.5 million houses like that. So we ended up with 10 million homes with an average mortgage of $250,000, so it's $2.5 trillion, which is the core problem. There was the repeal of Glass-Steagall, under huge lobbying pressure, $200 million of lobbying at Congress to allow travelers to be bought by Citibank. There was the 1% interest rates for many years by Mr. Greenspan to stimulate the economy, which therefore made people look for riskier assets and allowed households to buy things which they were beyond their wildest dreams. And then the SEC in 2004 allowed the 5 great investment banks, none of which, of course, are still investment banks, most of which don't exist, to reduce their capital ratios to 2.5%. Now, they were all politically driven activities. We're now back into politically driven activities because following the crash, everybody said something must be done. But although finance, as you quite rightly said in your introduction, covers many other aspects, insurance and asset management and all sorts of other things, it's the banking which tends to be in the spotlight. And banking was invented over 500 years ago by the Italians. And it's pretty simple stuff. And over the years, you have a 10% capital ratio, lots of liquidity, and everything visible on the balance sheet. Those are basically the 3 things you need to do. We lost the plot in the UK, you lost the plot here on each of those 3 things. And so something is being done. Well, Glass-Steagall was 37 pages long. Dodd-Frank's is 848 pages. It so far spawned 400 regulations which cover 8,800 pages, and those who know about these things say that by the time all the regulations have been written, it will be of the order of 20,000 pages. Ditto, Basel I was 30, Basel II was 317, and Basel III, which is still being negotiated, is currently 616. It's balmy. It cannot possibly change the core activities. Things like the Volcker rule, I think, are sensible. Banks should be there for their customers. They shouldn't be playing with other people's money. There's a clear conflict of interest between the activity of giving credit and the activity of investing for yourself. So I think there should not be proprietary trading. There's perhaps a 4th principle which the Italians didn't think about 500 years ago. And if you bring in all this regulation, what happens is the more closely you define it, the closer to the line will companies go. So if it's just principles, the companies have to make judgments about where they should be. Once you say you can do this, you can do it. And the stockholder pressure to operate free enterprise within the legal framework is strong to get as close to the line as you can. So you get lots of lawyers in to tell you, yes, you are on the right side of the line still. Judgment is suspended. Once you politicize it in any way, you've got problems, as Roy was saying. And what really happens is you transfer the responsibility from the company to the regulator, from the regulated to the regulator. Because it's the regulator who's now saying exactly what the company can do. We've had examples in the UK where the FSA now approves directors and things for banks. So of course when it goes wrong, everybody says, well, you should have approved that person, most notably in the case of Bob Diamond, the chief executive of Barclays, who was approved for that role about 18 months ago. So as you have regulation, you actually take responsibility away from the people you're trying to regulate. And so the whole thing is just really, in any sense, not a good way to go. Basic principles and put the onus on the companies to get it right.
So, Edmund, you must have thought you were coming to New York to be cheered up, and probably sitting there wondering what on earth you've run into here. What are your reactions to what you've heard so far?
Oh, first, I think that Eurobashing is of no use because it feeds distrust, and I think that it has a very negative impact on the economic activity and on the world system. So, but I would like to just to put an emphasis on two peculiarities of the banking sector in continental Europe, which, in my opinion, are very, very important. The first one is that in the financing of the economy, compared to the US, in the US, 70% of the financing comes from the market, 30% comes from the banks. In continental Europe, it is exactly the reverse. 70% are from the banks and only 30% from the markets. Securitization is much, much less in Europe than in this country. And so it's very important. Why? Because when we decided last summer of last year, under the pressure of international institutions and the IMF especially, to make capital and liquidity ratio more stringent in continental Europe, this had a very big impact on the portfolios, the credit portfolios of the banks, which were reduced very suddenly. And it led to some kind of a beginning of major credit crunch. And this has been the reason why Mario Draghi was forced to put 1,000 billion euros of liquidity on the market, the LTRO operations. And the story is not over. Actually, my guess is that the pressure of the new Basel III rules, which are implemented actually in continental Europe through liquidity ratios mainly, have a very bad impact on economic activity. And it's a reason why the economic activity is not going, is not better. One of the reasons, not the only one, but one of the important reasons. My second remark is about something which is extremely important and the heart of the euro crisis. It is a correlation between the sovereign crisis, the sovereign market crisis, and the banking sector. In fact, in Europe, the banks hold a much larger amount of sovereign debt than in the US. In Spain, for example, it is 20%. In the US, it is 2%. And so the impact, this correlation, which you see in the CDS market, this correlation is, works two ways. When the weakened banks jeopardize the fiscal stance, and through the bailout, you saw it in Ireland, and we see it actually in Spain, and the other way around. When you have a sovereign debt, which is in the sovereign debt market, which is in crisis, then it has a big impact on banks. And so the solution to this problem, which is extremely important because it leads to fragmentation of the financial markets in Europe, in continental Europe. The spread between the interest rates among the countries are very important. When you want to borrow money in Spain, the price you pay is much higher than in Germany. And so the discrepancies in economic activity are widened through this fragmentation. So it's very important to tackle this issue. And this is the reason why OMT operation first, and second, the banking union, the fact that we decided to allow the new bailout fund, EMS, to recapitalize banks is so important. Because we need to avoid a new Irish scenario, when the collapse of the Irish banking sector led to the collapse of the Irish public finance. Thank you.
Okay. Unfortunately, time is pretty much up, so I'm just going to ask each of our panelists to end by coming up with one thing that would make them more optimistic over the next year. I want to ask each of you, I'm going to start with Greg, I'm going to ask each of you, what would be one regulatory change that would make you feel, if it happened in the next year, more optimistic than you are at the moment? And we'll go down the panel and wrap up. I'm sorry that we haven't had a chance to go to the audience for questions, because it is such a large panel, and I already feel we've barely started our conversation, and we could probably go on for weeks and still be saying, I think, quite interesting things. So you may all be asleep by that point, but nonetheless. Greg, what's the one thing that would make you feel slightly more optimistic about the world if it happened?
I guess we could, the dollar has been the world's reserve currency since Bretton Woods, and the world has changed drastically since then. Perhaps we have a rethink of that. Perhaps a basket of currencies could smooth volatility and better reflect the global makeup of the world. It could have a component of hard assets to it as well, because if it's still fiat currency, it's still very suspect. And the other things is to reduce systemic risk. It's imperative that we restore investor confidence with more transparency.
Okay. Roy.
I'm going to say one word which I urge you to learn about. It's something called Bitcoin, which is a fixed money supply, anonymous, completely fungible, international electronic currency. And it's very, very interesting that you can't make more of them. And it's a lot more useful than gold. And you can actually look at how the world's expectations for fiat currency are moving by looking at the price of Bitcoin per dollar. And if you're curious about it, there's a website called MTGOX, Mt. Gox, that shows you the daily price of Bitcoin. And recently it's gone from 4 to 13. So $13 per Bitcoin. So in other words, Bitcoin is strengthening, suggesting that people are losing confidence in fiat currencies relative to this hard currency, which is kind of similar to gold, but you can buy and sell things on. And this is so my one prescription would be this becomes adopted as a useful currency that you can buy things on Amazon and your local grocery store.
We write about Bitcoin in my book as well, and I guess we talk a bit about the bubble that took place there, arguably last year. But you now think that's settling down as a market?
Yeah, I think they've got it now.
Okay.
Well,
Jim.
certainly it's gone mainstream, because it was featured, I think, on an episode of The Good Wife. What needs to be restored is trust in the system. The whole system is built on trust, and that's what's been eroded. To me, that would be in the banking system, some control over leverage, or said another way, capital requirements. And the second thing is transparency.
Of what?
Transparency of financial instruments, who owns what, who's has obligations to whom, and who you're dealing with, et cetera. I mean, the opacity has not worked in our favor. And the last thing I'd say in governance, and this is a very small point, but the sooner the banks around the world start to separate the role of chairman and chief executive officer, the better, because that at least puts some discipline in to the process.
Paul?
I certainly agree with that last point. I think that's key. I think I mentioned I was the director of Standard Bank, and it's noticeable that that's based in Johannesburg, and we had no problems during the financial crisis. Not, I hasten to add, because I was on the bank. But it's noticeable that in Canada, India, Australia, New Zealand, other Anglophone countries, there was no real issue. And the reason is they didn't change their regulation. So I would just suggest the US and the UK adopts the Canadian regulations.
Yeah. Maybe Canada should just take
That's
over.
That's why Mr. Carney is chosen. All he has, clearly.
I'll make two suggestions. One is on a micro level, which is companies and investors, and one on a macro level. On the companies and investors side, they have to become more risk intelligent because the nature of their business models, the nature of the environment is such that we're going to be faced with managing these crises and risks indefinitely. And once being equipped to do that is the secret to sort of creating lasting value. So that's on that side. On the macro side, the environment is extremely hostile to building businesses, hiring people, investing, etc. So whatever combination of regulation, tax policy, etc., will make this environment less hostile. To me, that's key to growth.
Paul?
I'd like to see Germany leave the euro and maybe join the British pound.
What?
Well, yes. One thing, apart from that, no, please, give us one last thought. What would be one thing that made you feel
I got one, and I'll speak for I think I can speak for Edmund with this one, too. Paul mentioned humans. I think humans make sense of the world by abstracting from particulars to general and forming theories, and there's been no theory has been more powerful than that of purposeful behavior by rational actors, although it has its flaws, as we all know. So I think rather than every economist have to go start a business, I think every business person should study economics, ideally at University of Chicago, like Edmund and I have done, and the world would be a smoother place.
Well, on that challenging note, let's thank this panel for I think a really broad and stimulating conversation, and I hope we'll carry it on afterwards. Thank you.